Welcome to the deep dive. This is where we take those really dense corporate reports, the stacks of research, maybe even your own notes, and we try to boil them down into clear, actionable insights just for you.
Exactly. Because you look at these financial results and you wonder what's really behind the numbers beyond the percentages.
That's precisely it, and that's what we're digging into today. So our mission for you is to unpack the Q1 FY26 financial results for Care Ratings Limited. These just came out August 5th, 2025.
Yep, hot off the press. And we've got works, the official board meeting stuff, the full unaudited financials, both standalone and consolidated.
The auditor reports, press release, investor presentation, the whole dinner package.
Right.
And our goal, highlight the key takeaways, understand the actual financial performance, look at the economic context shaping it.
And see what strategic moves Care Ratings is making. To stay competitive, to grow.
We want to give you that. Okay, so with that mission laid out, let's get into the core numbers. How did Care Ratings actually do this quarter? Starting with the top-line figures from their investor release.
Comparing Q1 FY26 to Q1 FY25, right? Year over year?
Exactly, year over year. And we see some pretty robust growth. On a standalone basis, that's mainly the core credit rating business. Operating income hit just over 75 crore rupees. That's 756 million rupees. And that's a strong 16% jump year over year.
16% is solid growth for the core operation.
Definitely. And then you look at operational efficiency, EBITDA earnings before interest, taxes, depreciation, amortization.
Always a key metric for core profitability.
Right. It came in strong at about 27.2 crore rupees. That shows a really impressive 36% margin.
Wow, 36% margin on standalone. That's quite healthy.
It is. And profit after tax, PT, the bottom line for shareholders, that was about 29.1 crore, a solid 21% year-over-year increase with a 32% margin there.
Okay.
And the basic earnings per share, EPS, stood at 9.72. So yeah, clearly strong standalone numbers across the board.
That's a really crucial starting point. And what's striking, as you said, is the health. But it's not just isolated to that core business.
Ah, right, the consolidated figures.
Exactly. If we look deeper into the consolidated numbers, which bring in the whole CareEdge group.
Subsidiaries like Care Analytics, Care ESG, CareEdge Global, the international bits too.
Yeah, Africa, Nepal, all of it. It actually paints an even broader picture of strength. For instance, consolidated operating income reached almost 94 crore rupees.
Okay, so higher than standalone.
Right. And that marks an even higher 19% year-over-year growth.
19% consolidated. Interesting.
And consolidated EBITDA was about 27.8 crore rupees. That's a significant 28% year-over-year growth, though the margin is a bit lower at 30%.
Still a good margin, 30%.
Absolutely. And the consolidated PAT stood at roughly 26.5 crore rupees, which is a 24% year-over-year increase. Basic EPS for consolidated was 8.61.
So growth pretty much everywhere you look, standalone or consolidated.
Pretty much. And, to really get these results, it's worth looking at some underlying shifts in the financials, like employee benefits expense.
Okay, what about it?
For the consolidated results, it saw a noticeable jump, about 53.7 crore rupees in Q1 FY26, up from 45.7 crore in Q1 last year.
So higher costs there, why?
Well, it isn't just a cost drag. It seems strategically linked to their ESOS 2020 scheme. That's the employee stock option scheme.
Okay, incentives.
Right. This quarter, they granted 7,500 options and allotted over 25,900 equity shares under this scheme.
So they're investing keeping their people.
Exactly. It signals confidence, a commitment to retaining talent for future growth, even if it slightly dings the immediate margin. It's a long-term play.
Makes sense. Now, connecting this performance to the bigger picture. The Indian economy is obviously a huge factor for a ratings agency based here.
Yeah.
What's the overall economic pulse telling us right now?
Yeah, the Indian economy's been, remarkably resilient, actually. FY25 saw a robust 6.5% GDP growth.
Pretty strong.
Very strong. And it was really underpinned by two main things. First, a big improvement in private consumption growth that climbed to 7.2% in FY25, up from 5.6% the year before.
So people are spending more.
Seems like it. And second, strong investment growth, 7.1%, mostly driven by the government's continued push on capital expenditure, or CapEx.
Right, the infrastructure push.
Exactly. Now, the high-frequency indicators, they're a bit of a mixed bag. We've seen good trends in things like GST collections, e-way bills,
No.
but some moderation in other areas like auto sales. So overall, it's a picture of a domestic economy with pretty solid fundamentals, but maybe not firing on all cylinders everywhere.
Okay. So within that economic context, one area that's always a bellwether for rating agencies is fundraising activity. How did that look?
Yeah. And this quarter, the numbers here are, well, quite compelling. A really significant uptick in Q1 FY26 compared to a year ago.
Like what?
Well, take corporate bond issuances. They hit 3.4 lakh crore, that's 3.4 trillion rupees.
Wow. And the growth?
A substantial 66% higher year over year.
66%. That's huge.
It is. And commercial paper issuances also got a boost. Reached 4.5 lakh crore, or 4.5 trillion rupees. That's up nearly 19%.
So a lot of debt being raised in the markets.
A massive amount. And that's a crucial point, It's not just the volume. It really points to a shift in how companies are funding themselves.
Moving away from banks.
Somewhat. Less reliance, perhaps, on traditional bank credit means the capital markets become more central, and that inherently means more business for credit rating agencies like CARE.
Right. More bonds, more commercial paper means more stuff needs a rating.
Exactly. But it's not uniform across all financing channels. Bank credit itself tells a slightly different story.
Okay, how so?
Overall bank credit offtake, it actually moderated, down to 9% year-over-year growth as of May 2025. Compare that to almost 20% growth a year ago.
Big slowdown there. Why?
Few reasons cited. An unfavorable base effect from last year's high growth, some subdued momentum, and banks are focusing more on managing their credit-to-deposit ratio, the CD ratio.
Meaning they're being more careful about lending out deposits.
Essentially, yeah. A bit more cautious, perhaps. And specifically, credit growth to large industries and services moderated quite a bit, down to 5.9% versus almost 17% last year.
Okay.
And interestingly, credit growth to NBFCs, non-banking financial companies, it actually contracted by 0.3% as of May, a big swing from 16% growth last year.
A contraction. Why them specifically?
Well, partly regulatory tightening on NBFCs, base effects again, but also they're increasingly relying on capital market funding themselves.
Ah, so they're issuing more bonds and CPs too.
Seems like it. Which again circles back, good for ratings agencies, maybe less so for direct bank lending to them.
So it really looks like the debt markets are having a moment, and CARE Ratings is definitely benefiting from that trend. Their MD and Group CEO, Mohul Pandya, commented on this, right?
He did, yeah. Mohul Pandya highlighted that their strong performance was, and I quote, primarily driven by a healthy uptick in ratings business across the segments.
Makes sense given the fundraising numbers.
Absolutely. And if you look at their consolidated segmental contribution, how the different parts add up, the ratings business, the core, accounts for a huge chunk, 88% of consolidated revenue.
Okay.
That came in around 82.9 crore rupees, showing that robust 18% year-over-year growth we talked about.
Right, but what about the other 12%? The non-rating stuff.
That's actually where it gets quite interesting. The non-ratings business, while smaller at 11 crore rupees of revenue, it showed even higher growth. A remarkable 30% year-over-year increase.
30%. Wow. So what's in that non-ratings bucket again?
Things like their analytics, consulting, ESG services.
So this really shows a balanced performance then. The core ratings engine is strong, but these other advisory and analytics areas are growing even faster.
Precisely. It points to a deliberate, diversified growth strategy. They're not putting all their eggs in the ratings basket, which seems pretty smart in today's dynamic landscape.
Definitely a smart move. Okay, shifting gears a bit, let's talk about how CARE Ratings is strengthening its foundation. Governance, stability. There were some board reappointments.
Yes, that's right. The company approved the reappointments of 2 independent directors, Mr. G. Mahalingam and Mr. V. Chandrasekaran.
Both for 3 years, subject to shareholder approval, I believe.
Correct. Effective later this year, November and December 2025, respectively.
And what's really striking about these two is the sheer depth of experience they bring, especially in regulation and finance. Mr. Mahalingam, his CV is incredible.
It really is. Over 4 decades across financial sector regulators, RBI, SEBI.
Covering everything from market development, Forex reserves, debt management, bank supervision. He was even a whole-time board member at SEBI.
Handling mutual funds, stock exchanges, corporate governance. And he currently chairs SEBI advisory committees on secondary markets and the corporate bond market. I mean, that's deep expertise. He holds masters from IIT Kanpur and an MBA, too.
Just phenomenal experience.
Yeah.
And Mr. V. Chandrasekaran, he's the chairman of the company.
Yes, and he's a chartered accountant with over 30 years in life insurance finance, housing finance, mutual fund investment.
Deep into investment decision-making, monitoring, risk management.
Right. So, the question really becomes, what's the actual value of having directors with this kind of background, especially for a ratings agency operating in such a dynamic regulatory world?
It must be immense.
I think so. Their decades of experience provide invaluable oversight, strategic guidance. They can help navigate complex compliance, anticipate regulatory shifts, ensure really robust governance.
Which is absolutely critical for a CRA, right? Credibility and impartiality are everything.
Exactly. Their presence sends a strong signal about the company's commitment to best practices and strategic foresight.
Okay, so strong governance. But they're also clearly focused on expanding horizons, this carriage ecosystem idea.
Yes, they position themselves as a knowledge-based analytical group, not just ratings.
Right, offering credit ratings, analytics, consulting, and sustainability services.
Mm-hmm.
And their subsidiary structure really shows this off.
You've got Carriage Ratings, obviously the second largest in India. Then Carriage Global IFSC, that's the one just accredited by the RBI as an international CRA in July.
Big step for them.
Huge. Plus the international operations in Africa, Mauritius, South Africa, and Nepal.
And beyond the ratings.
Well, there's the advisory services arm doing bespoke consulting, feasibility studies, ESG strategy, even green and social bond opinions, which is a big growth area.
Sustainable financing.
And then the analytics services, risk consulting, digital banking solutions, various risk analytics platforms like their integrated credit platform.
So, yeah, it's really evolved beyond just being a rating agency. It's aiming to be like full spectrum analytical powerhouse.
That seems to be the goal. And what's also clear from their Q1 activities is how aggressive they are with outreach and building influence.
How so?
Well, just look at the numbers they put out. 10 reports, 10 webinars, over 1,800 media coverages.
Wow, 1,800.
Yeah, with over 550 headlined. Plus 36 opinion pieces, TV interviews, knowledge-sharing forums. They are out there.
That's a serious push for thought leadership.
Absolutely. It's not just visibility. It's about shaping market perceptions, building trust in their analysis. And they've cemented key partnerships, too.
Like the one with Invest India?
Yep, and MoU as a knowledge partner there. And also being a knowledge partner with Business Today for their Most Sustainable Companies Awards.
And they did that event in Sri Lanka too, right?
That's right. CareEdge Global hosted the Dialogue on Credit and Capital in Colombo back in June, collaborating with IFSCA, NSE and IX, and others. This level of engagement, domestically and internationally, really speaks volumes about their strategic push.
Okay, so bringing it all together, looking ahead, what does this all mean for you, our listener? The MD & Group CEO sounded positive about the start to FY26, despite, tricky global conditions.
He did, but he also cautioned, quite rightly, that financial performance is best viewed through an annual lens, meaning one strong quarter is good, but it's part of a longer game.
Right, consistency matters.
Definitely, and their future commitments seem clear. Keep deepening core capabilities, expand geographically, and sharpen their competitive edge.
And the broader economic outlook. What are the headwinds and tailwinds?
Well, the domestic economy is expected to hold up reasonably well, which is a positive. But global uncertainties could definitely put a damper on private capex, private investment.
Right.
And that consumption improvement we saw, that remains a critical monitorable, as they say, needs to keep going for sustained growth.
Any positives?
Yeah. On the plus side, you've got easing inflation potentially, maybe some RBI rate cuts down the line, hopefully good monsoon prospects. Those all help the domestic picture.
The external environment
Remains volatile. That's the big challenge, especially for any company with international links or ambitions. It's really a balance of domestic strength against those global headwinds.
So it leads to a final thought, really. Given this evolving global economic picture and this clear shift towards more diverse financial instruments, beyond just bank loans, how might the role of credit rating agencies like Care Ratings keep transforming?
Good question. How do they need to diversify their offerings even more to serve these changing market needs in the coming years?
Exactly. What new kinds of knowledge-based analytical services, like maybe deeper dives into supply chain risk or climate risk, or even more complex derivatives, what might become truly indispensable in a world that's just increasingly focused on data, sustainability, and resilience?
Definitely is something to think about as you watch how this space evolves.
Yeah.
What becomes the next essential analytical service?
Food for thought.